We are rapidly approaching the end of the year, and if you are going to be stuck with a 40, 45%, 50% tax liability for 2025, I'm going to share 3 strategies that we can use to help you reduce that tax obligation, reduce that out of pocket expense, and save you some money. If you don't know who I am, my name is Jeff Hanna. I run a financial consulting firm called HFS, where I help high income earners like yourself, high net worth individuals, reduce their tax liability and ultimately build more wealth. Now, these strategies that we're talking about here today, these are only going to apply to those of you guys making $375,000 or more per year. These work for W-2, 1099, business owners, investors, corporations, and trust. The only caveat to that, the 375 number, is that if you have maybe $1 million, a $2 million, a $3 million 401k and you want to convert that, remove the taxes from it, which is strategy number 3 I'll explain, then you wouldn't have to have that 375 income. I have another video on that. I'll link it below. Anywho, without further ado, let's get right into it and talk about the first strategy. So the first strategy is going to be one of my favorites. These are tax bonds. So let me give you the background on this. In 2018, a hedge fund raised money from investors. In 2019, that hedge fund, they went out and bought a bank. In 2020, the bank failed. Now, as a result, these investors, they faced hundreds of millions of dollars in operating losses. But due to the CARES Act, these losses are actually eligible to be carried forward at 100% of their value. This allows them to offset taxable income from 2021 onward. I'm going to come back to that. But just remember, we are carrying these forward 2021 onward. Now, what the hedge fund did is they created a trust that actually holds these losses. And then they issue tax bonds so investors can access the tax benefit. Now, you can buy the bond at a price of equal to 75% of your combined state and federal tax liability. The face value of the bond is going to equal your adjusted gross income. So maybe you made $500,000, you buy a bond for, you paid $100,000 in taxes, you buy a bond for 75. That bond, when it converts into the ownership interest of the trust, it's going to be worth $500,000 or your adjusted gross income. So when you file your return, the losses pass through to offset taxable income. Big picture, saving you 25% on your federal plus state tax liability. We can combine them, yes, and we can go all the way back to 2022. I know this is 21, but now we're only in 2022. So big picture, okay? If you owe $100,000, if you haven't paid 24, for example, and you're about to pay $100,000 in taxes, instead you can buy a bond for $75,000, offset your taxable income, and pocket the difference of $25,000. Now, this is a semi-complex strategy. I know I just gave you the 10,000-foot overview. There's obviously more that goes into this, but from a big picture, that's how it works. But we have all the tax memos, etc., to back this up. Strategy number 2. This is going to be tiny homes. So these are great for W-2. Those of you guys that make W-2 income, I'm sure you hear all the time, especially from your CPA, there's just not much else we can do, besides the 401k, the IRA, maxing out those accounts, writing off your mortgage interest. Those are all great. But then the question arises of, hey, what's next? What else can I do? So tiny homes is a solution to that. It's an option for you. Now, more often than not, I'm just going to read from the screen and kind of give you the brief overview. When there's a natural disaster, it creates an immediate housing crisis. So think the Palisades fire, think Hurricane Helene in North Carolina, the Lahaina fire in Maui, tornadoes in the Midwest, etc. Now, when that happens, government agencies like FEMA, for example, they come in and they provide solutions. But the solutions are often criticized as ineffective and inefficient and ineffective. So short-term programs like hotels or rental assistance, those provide relief, correct, but they drive up local costs, they strain the economy. The survivors, when you actually go out and talk to them, they say they have to do paperwork, there's confusing eligibility rules, they have limited access to aid, leaving many people without support. And that's where tiny homes actually come in. So these are container-based housing systems. They're built for disaster response. They can be set up and deployed in about a half a day. Really cool product, actually. Each unit is going to hold 2 private homes, and it restores stability immediately. Because if you think about it, we can load a bunch of these tiny homes onto in shipping containers, put it on a train, ship it out to wherever that natural disaster was, and have hundreds of homes set up for these people displaced from these natural disasters, in a matter of days. So very, very beneficial product for these people. Now, from a tax perspective, these qualify for 100% bonus depreciation. So you'll get to write off 100% of the purchase price, but you only put 20% down. The remaining 80% that's seller financed, to pay that note, you're not going to use cash out of pocket. You're going to lease the tiny home to the government. And there's a management company that does all that in the background. So it's not like you have to go out and get the government contract. That's already all handled for you. Now, again, these are being used to solve that housing crisis that follows natural disasters. So for a $500,000 home, you put $100,000 down, you seller finance $400,000, but you get to write off $500,000. So what you're doing here in this scenario, you're trading a 40% tax obligation, a 40% tax bracket for a 20% down payment. Oops, my Wi-Fi went out. I hope that doesn't mess up the video. Okay, it's back on. So sorry about that. But that's called tax arbitrage, right? The 40% tax bracket, you're trading that for the 20% down payment, and you're going to pocket the difference. So in that case, it'd be about 20%. Now, it doesn't clean up 100% of your taxes. Let's say you make $600, you're going to pay $200. You put 20% down, $100,000 to get a $500,000 deduction. Well, now your taxable income is at about $100,000, so you'll pay some tax on that. So strategy plus taxes is the out of pocket. You subtract that number from whatever your original tax obligation was, and you pocket the difference. Those are your net savings. Now, the numbers that I just gave, those are not official numbers. Those are not numbers that I've plugged into tax software or anything like that. All I'm trying to do is illustrate a point and share the concept. Although we do run the numbers before you decide to buy something like this, in order to save money in taxes, we do run the numbers so we know exactly how much you're going to save. And just so you know, the formula that I use internally, the concept, right, is, hey, what's the least amount you can spend to save the most amount of money? That's what we're trying to accomplish here. Okay, now, final strategy. Strategy number 3, that is the K1 conversion. You've probably seen me talk a lot about this if you follow me on TikTok or Instagram. I have a YouTube video that explains this in depth, so you can go watch that after. This is not only going to work for your 401k IRA, your deferred comp plans, all these pre-tax retirement accounts as a way to remove the taxes from them. You could also invest into this private fund, receive a paper loss for 60 cents on the dollar. That's going to offset active income. Now, there's a lot of different opinions from people on the internet, from the Monday morning quarterback on the internet that is saying you can't use this to offset active income. You can't use the K1 loss to offset active income. Not true. The CPA that designed this fund set it up so that it can, and we have all of the documents and memos to support it. So if you want information on that, go below and you can set up a time one-on-one to meet, and I'll walk you through exactly how it works. But from a high level, here's what we're doing. This private fund and this investment into this private fund, it's going to generate 2 things for you. The first is going to be a K1 loss that offsets the taxes due on your 401k distributions, active income, etc. And number 2 is going to be a fixed 10% dividend annually. Now, where does that 10% dividend come from? Because everyone's like, oh, when I see these comments, from CFPs on my TikTok page and on my Instagram page, they say, how can you say 10% fixed dividend? Well, with the sale leaseback structure within the fund, we are collecting a 36-month lease payment up front, day one, cash sitting in a money market account, which is how we pay the dividend. And then to get the return of capital, what we're doing is we're selling the building back to the original owner at the end of that lease agreement. It's all in the contract. And that's how we get the fixed 10% dividend, is from the 36-month lease payment collected upfront, day one, sitting in a money market account, earning interest. Now, again, I have an entire video on this, but big picture, it's just going to give you a way to break your 401k out of that taxable environment without paying any taxes. And then it can also reduce your income taxes this year. So those are 3 strategies for you that you can look at for 2025. We are rapidly approaching, as I said, the end of the year. If you're making $375 or more, $70,000, $80,000 or more of taxes, we might be able to help at 50, but really we want to see that income at $375 or higher W-2, business owner, 1099, etc. Tax bonds give you a 25% discount or refund. We can go back and amend 2022, 23, and then 24 also if you already paid. Tiny homes, that's going to give you a leverage deduction. You put 20% down, you finance 80%, you write off 100% of the purchase price. And then K1 conversion, remove 100% of the taxes from your 401k, IRA, deferred comp, etc. Additionally, you're going to get a 60-cent loss on the dollar on your investments into it. If you're doing it just, hey, I want to put 100 grand in cash, you're going to get a 60% loss, so $60,000 loss in that scenario. And we run numbers for all of this. So if you want to meet one-on-one to talk about, hey, this is my situation. What do you think we could do? How much do you think I can save? You can find information at the link below. Hope to talk to you soon. Have a great day. Take care. Bye.